Siddharth, coming back to you on the same point that Dhananjay ji also made, when we compare it with the other new age giants and also the traditional retail companies as well, we have to just somewhere justify what it is coming in at as well. Now, some critics have pointed out a $6 billion valuation for the entire eyewear industry and an $8 billion valuation for Lenskart again is something that everybody is questioning. At the same time, people are questioning that, Shankar Sharma did say that, it's in fact coming in at a cheaper valuation to what Nykaa or Paytm or Zomato had. So it's a steal deal. That's what he's marked out. Secondly, we actually saw the listing gains and losses, something that was being played on the show also for all our viewers to see. So Nykaa with a 377 times valuation listed at a 79% uptick, and then thereafter we saw everything is history after that. Paytm again listed on a loss, a 9% listing loss that we actually saw. And again, we actually saw, of course, there was no earnings there. Swiggy, again, a 10% surge. Urban Company, about a 57% surge. And Lenskart is actually yet to be seen. So how are you looking at comparing with the new age tech giants? How are you comparing with the traditional retail space? And all these points, how would you justify them?
I think the best way to compare them is actually like-to-like peers. I think comparing new age companies to new age companies is a bit of an apples and oranges comparison.
Okay.
Yes, they're all fruits for that matter, but it depends on what your appetite is and where you believe these kind of gains can end up happening. Like I said, if you look at the just tackling the first question you raised as of now with regard to the size of the company versus the overall Indian eye care market, I think that's a fantastic way of people actually massaging these narratives for their own ends and means. It's a fairly unorganized place as there as of now. The chunk of the revenue comes, but close to 40% of the revenue actually comes from overseas. I think a large number of investors coming in are looking at that overseas revenue growth and saying because this person has spent a large amount of time getting vertically integrated and thereby happy to actually reduce costs. And the EBITDA margin improvement from about 6.8% to 14-15%, hopefully going to 20%, does actually give them a lot of cause to end up actually believing that this company is now actually on a profitable path. So long as it continues the growth, they will end up actually giving that valuation. I think the fundamental arithmetic of investors is twofold. Number one, they're putting in many of them are participating to learn how this company can end up operating, to see how it ends up actually growing over there. Now the mutual funds have put very large sums. I think it's about 100, 150, 200 crores compared to their size book of lakhs of crores in terms of assets. It's a very small figure. So context ends up mattering over that. I think that's number one. The second thing also is, like I said previously, there are no comparisons to this. If you were to look at the Indian eyewear space as there as of now, if you look at what's happening in the rest of the tech world, you've seen Apple that's going to do something when it comes to smart glasses. You've seen Boat, etc., end up actually manufacturing into that. They've already done a deal with Qualcomm as of now to allow them to end up actually integrating those kind of chips. So eyewear is going to go from being your prescription-based glasses to something that's more fundamental and that's actually driven by tech. And when investors end up looking at that kind of niche growing area as of now, Lenskart is the only one that comes. So I don't think most of the media narrative is about traditional multiples. No one's actually talking about these qualitative aspects that can end up actually driving up that price. I think the fundamental thing remains for all these companies. Investors may get very happy with that initial listing gain, but if the performance doesn't match the numbers and the narrative, then they end up actually selling that particular stock and going. Unlike the private market where these valuations remain for a long period of time, in the listed market, one wrong thing, if the investors don't buy your story, prices end up actually changing dramatically. So that is a risk that they end up actually taking. And I think Peyush is a smart enough entrepreneur to understand that, which is why he's looking to finish his IPO, concentrate on business, and then end up proving the market right or wrong through performance itself, not through narratives.